Okay, so it looks like we are live for today. Well, since we've been doing these YouTube live vlogs or whatever you want to call these, we've been having the opportunity to sort of string things together and really kind of give people a sort of play-by-play. Earlier this week, we talked about a couple of warning signs in the market, broadly speaking. And today, I want to take a minute and show you guys why particularly technology stocks are starting to look a little bit frothy here for the near term. Just so you know, this is something that we communicated in real time with our coaching clients, our advisory clients, and the Clubhouse members. So this is not something that I'm just randomly coming up with right now. This is something that is definitely thematically something that we are concerned about. Technology stocks right now. A couple things. Number one, we're not talking about selling tech stocks blindly and never going back to these things. It's more of a near-term situation, but we do think they're very frothy near term. Number two, and I'll show you the statistic in a minute. And number two is that their earnings reports are coming up. So this week, for example, Amazon, Netflix already came out. We have Microsoft, we have Google, Alphabet this week, and then next week, of course, a lot more. So into these earnings reports, a lot of these stocks have gone literally parabolic. And so the other thing to keep in mind here is that the S&P 500 right now, I think it's about 25% of the S&P 500 is technology stocks, which historically is high, okay? And that's just because these stocks have rallied a lot. So let me show you what this looks like on the chart so you guys can kind of contextualize how overbought these things are. Let me quickly change around the camera here. All right, here we go. All right. So we're going to start off with the big one first, and this is the NASDAQ 100. Okay, so let me just kind of make this a little bit more stable. And it's really just two simple things we need to look at. Number one is the rate of change, and number two is the slope of the line. And really, it's kind of the same thing. So what you can see here is the NASDAQ 100, which is also kind of the only chart we need to look at because everything's correlated so strongly right now. So if you look at the NASDAQ 100, and we've talked about this in previous YouTube lives, you can see that we are certainly overshooting here by just about any measure on a multi-year chart. If you go back even further, even here we are overshooting from a long-term perspective. The longer-term trends, you can kind of draw those lines as follows. So that's the very simple way of looking at these, right? So you can see here by just about any measure, we are way overshooting here. That's number one. Number two is the momentum, right? So we not only do we have a chart that's going from a steep slope to an increasingly steep and now actually vertical so far this year, we also have a moving average convergence divergence oscillator, which is essentially labeling this entire group of stocks record all-time overbought, okay? Or at least all-time as far as going back to the year 2000 where we had the internet bubble. You can see from a simple momentum perspective, this group of stocks is dramatically overbought. And it doesn't really matter which ones you look at. You can go a little bit deeper and look at something like Google, which is Alphabet, which again, these are great long-term growth stories, but they are a concern as far as I'm concerned for the near term as we head into earnings reports. It's the same chart here. It looks almost exactly like we saw in the NASDAQ 100. Same thing for something like Amazon. Same thing for something like Netflix. These are all the same charts. And the concern here is that if these stocks start to give back something, which they most likely will, then we're going to have a situation where the broader market, considering how overweight people are in this, A, because these are the stocks that people are trading, and B, because all the indices now are very largely weighted with these stocks, as they should be, because these stocks have such large market capitalization. So if these stocks start to correct just a little bit, they could really start weighing the market. So the warning sign here is not so much that you need to start hiding under a mattress and sell all these long-term positions. The warning shot here is that we could see a fairly swift, 5 to 10 to 15% corrective move in these stocks, and it wouldn't change anything at all. So like even Amazon, just to get it back to 1220, which is I think more or less where we started the year. I mean, that's what we're talking about here. Let's quickly do the math here just so you can kind of see. We're talking about let's call it a 15% corrective move, which is really nothing in the grand scheme of things. It doesn't change any, it doesn't break any trend lines. So that's my warning message here this morning. Not a warning message, but just to be very careful. We've actually gone underweight technology stocks here for the near term because of everything I just showed you. And so, let's see what happens. But so you've been warned. That's our call for right now. We like these stories long term, but we're getting more and more concerned here for the near term as it relates to technology stocks. Hope this was helpful, folks, and I'll see you in the next YouTube Live.